Hello, my name is Gerald Haddock, Executive Chairman of Silver Star Properties REIT. I have spent over 40 years in the financial, real estate, oil and gas, and legal sectors, and I serve on numerous for-profit and not-for-profit boards, including the board for Meritage Homes Corporation, the Board of Trustees for the Baylor College of Medicine, the Baylor University Executive Investment Committee, and several others. In 2000, I founded and am president of Haddock Investment, which is focused on private equity and commercial real estate investments and oil and gas. Prior to 2000, I was co-founder and president and CEO of Crescent Real Estate Equities, a diversified, and I underline diversified because that's important here, real estate investment trust. At Crescent, we acquired commercial office properties throughout Dallas, including the Crescent Office Towers, 3 million square foot complex, probably one of the best properties in the state, Trammell Crow Center, which I negotiated personally with Harlan Crow, and all of Don Carter's assets in Dallas. And there are many that I could keep on naming that were clearly, like these properties, opportunistic investments. What I mean about opportunistic is buying an asset at a deep discount to replacement cost. One of my proudest accomplishments at Crescent was acquiring the undeveloped lots and town center assets in the Woodlands at just outside of Houston, Texas. I negotiated that deal personally with George Mitchell. Quite an honor, quite frankly. The reason I'm addressing you today is that Silver Star Properties REIT has an upcoming important consent solicitation to elect Gerald Haddock, Jack Tompkins, and Jim Steele. Remember those names. They are your incumbent outside directors standing for election at Silver Star for another term. This, of course, is our primary subject of our conversation today, but it has to be broken into several parts. The first part is, how did we reach the point we're at now? The work by this team of 3 outside directors to change the culture and the direction of Silver Star is an underlying message that will flow throughout our discussion today. And that's why we're here today. The second part is, how do we go from here to recoup losses and grow value for you, our shareholders, into the future? So let's begin. After the 3 of us, again, that's me, Jack Tompkins, and Jim Steele, began working together at Silver Star in 2020. We united as the 3 independent directors on the board to attempt to understand what was going on inside the company. What we discovered when we were turning over stones that, quite frankly, had never even been tilted, we began to find a lot of surprises. And we were immediately concerned about turnover at the executive level, lack of liquidity for shareholders, routine delinquent SEC filings of financial statements, reports, and a noticeable pattern of evasive comments at the board level, either by or concerning Alan Hartman's lack of focus on company business. Hartman was always busy, but not on company matters. More so, he was involved with developing succession plans for young, inexperienced family members, and thereby destroying morale for those seasoned long-term executives who we all wanted to keep and what was best for the company. By mid-2022, as our focus became stronger and more intense, we became concerned about the internal guidance that he gave the board from time to time. So we started delving even deeper, including having more in-depth conversations with members of management. So in mid-2022, your three outside directors, Jack Tompkins, Jim Steele, and I, led the board in analyzing the shortfalls in cash coverage for dividends. The matter was discussed with Mr. Hartman, and initially, he even denied that the shortfalls existed. At that point, it became apparent that what we had suspected was true. That is, that Hartman was not engaged fully in the business of the company. Then, in response to what we found, the three of us, Jack, Jim, and I, halted the payment of dividends until the issue regarding payment could be further evaluated. We discovered cash shortages resulting in part from the relationship that existed with tenants in both renewal and new lease situations, as well as respect to negotiating tenant improvements or not negotiating tenant improvements. Equally alarming, the company had been unable to raise capital, and the company was then actually incurring almost $2 million per year to support a capital markets team that was supposed to be raising capital, but simply was not doing so. This team did not raise capital, and our resources were overextended and grossly misallocated. Let me say it again. Hartman was always busy, but not always on company business. He spent his time and his focus regularly on his personal, religious, and political endeavors. Additionally, Mr. Hartman had directed the borrowing of cash from REIT 21 to subsidize what the company had been suffering through these shortfalls in cash. Well, this dramatically expanded the conflict of interest problems with Hartman-related entities because Hartman 21 was directly related to Silver Star. To make matters worse, these borrowings were not even approved by the Silver Star board and were also in violation of Hartman 21's charter. It's always important to keep Hartman 20, which is now Silver Star, separated, totally separated from Hartman 21. During this period, debt ballooned to about $322 million, and the SASB, securitized financing maturity of $250 million loomed just over the horizon. We three independent directors, as you would expect, led a strategic option analysis to resolve this looming issue. Mr. Hartman, after this was done, turned the idea of bridge financing, which was recommended by our investment banking. He turned it down on the grounds that it was too expensive. Adding to this situation that the debt maturity was just around the corners, our bankers told us that if Mr. Hartman is at the helm, Silver Star will not be able to raise any capital. So there was no way for Silver Star to obtain a refinancing or bridge financing at that time. Shortly thereafter, Hartman was ousted as chief executive officer, and the executive committee was formed and comprised of us, the three outside directors. Again, me, Gerald Haddock, Jack Tompkins, and Jim Still. The executive committee realigned the management structure and focused on strategic plans as recommended by the management team. We were offered to pursue several options, but the most attractive was the selling of our legacy commercial assets, what with office and other properties being out of favor with the pandemic downturn, and we decided to pivot into self-storage. So it was an easy decision to make because we also needed to get the sales process started earlier rather than later. These asset sales have been and are currently being executed in an orderly fashion while pivoting to self-storage assets, utilizing along the way Section 1031 exchanges to save taxes and preserve value. At the onset of executing this strategy, the executive committee organized company-wide a detailed review of all of the assets of the company before placing them on the market. So instead of just forcing our commercial assets into an open market fire sale, we elected to use brokers and negotiated and obtained the highest price feasible and that was available for the properties as they were placed staggeredly on the market, not at the same time. The executive committee set prices for all of the properties to be sold, and management has done, quite frankly, an excellent job at executing on this plan. This strategy has been and continues to be quite successful. Additionally, the executive committee undertook with management to negotiate an orderly and fair separation of Hartman and his affiliates over a number of months, including multiple day-long negotiating sessions, almost reaching an agreement. One got so close that at the 12th hour at midnight, only one signature was left. And guess whose that was? It didn't occur. The idea with these negotiations was for Mr. Hartman, 21, and the affiliates to go their own way, for Mr. Hartman to build a company, and Silver Star would move into the self-storage arena and do the same thing, but not be entangled at all with Hartman. Well, when Mr. Hartman realized that his efforts in negotiating to extract, and I mean literally extract, a much higher net asset valuation for selling his shares to the company, that is Silver Star, than other shareholders would have been able to obtain. Well, we realized then that these negotiations were going nowhere because we were not going to do a deal that disadvantaged other shareholders. So what did Hartman do? He immediately filed illegal les pendants liens and claimed erroneous interest and title with respect to assets that were being sold by Silver Star. Those that were selling well. Those assets were being sold, keep in mind, to timely refinance the SASB loan, which, as you know, was basically a looming maturity. But everything just grinded to a halt. To get around this nuisance, Silver Star was required to cause its Hartman subsidiary, not the parent company, to file a strategic Chapter 11 bankruptcy to clear these sales from the hurdles of Hartman's illegal actions. Silver Star expects that it will exit bankruptcy with about $370 million, counting leverage, to invest in its future business plan, that is, to primarily acquire self-storage assets. Silver Star is already below the minimum balance of our interim financing party with respect to the SASB loan to enable us to refinance the SASB. So it looks like, despite all these problems, despite the Hartman hurdles, we are moving fast to get this done. Although delayed and costing much more at Alan Hartman's expense, sales of assets exceeding $152 million have been made during 2023. Silver Star expects to have, as I said before, approximately $370 million to invest, and we're looking forward to being able to put these funds to work soon in our mission to reposition the company's assets into self-storage. We also intend to leverage the focused investment management expertise gained through the acquisition of Southern Star and the operations of Southern Star that we have been close to over the last 6 months. Further drawing on our extensive expertise, we are strategically positioned to broaden our investment mandate as part of our strategy to enhance shareholder returns. We will, in addition to self-storage, seek to acquire other attractive assets as a result of a network of relationships, expected availability of capital, and our ability that we have garnered over the years to structure transactions carefully and successfully, like we did quite successfully with Crescent. We may identify substantial opportunities for other types of real estate investments, where existing owners are looking to divest non-strategic assets and sellers subject to maturing credit requiring complex disposition structures enable us to complete their strategic plans. In fact, we have within the last 6 weeks began to develop this pipeline. That will give us an opportunity to invest earlier, not only in self-storage, but other properties that may be acquired at deep discounts to replacement cost. We'll be looking for traditional, immediate cash flow turnaround opportunities and properties focusing on secondary markets, particularly those in cities that are not necessarily urban city markets, but rather only short distances away where people are beginning to move as they move into the suburbs and out of urban environments. Local factors such as political environments, favorable tax structures, affordable housing, or even additional criteria that develops, particularly involving those companies that are moving out of the Northeast and the West Coast to Texas, which is already well documented, maybe too many. We expect this demographic shift to continue long term, and this migration of people is something that we want to be in front of. We welcome them, but we want to be in front. The demand for self-storage may be tracked through first-time home buyer markets and first-time home buyers on top of that, which are just getting started just like where I served for 20 years at Meritage as a member of that board of directors. Meritage shifted about 5 years ago, emphasizing the first-time home buying demographic, which we believe is directly connected to the underlying support for self-storage. We believe there could be a high demand for self-storage, so we're exploring opportunities that may be present itself to bundle some products together. Long-term mortgages have risen the past year or more, but normalized historical rates are around 4%. Current long-term mortgages have been much above, but are forecasted to come down by some experts. I believe they will be coming down quicker. Our goal is to pursue acquisitions that generate a NOI yield in the 6 to 8% range. And the reason I say that is with Silver Star coming out with $370 million of buying power, that's not going to be matched by many companies in the self-storage space looking for secondary markets, period. They just don't have it. They've already spent their money. We will be, in my opinion, the buyer of choice. We have what sellers want. They want to know when a deal is made, it will close. Having cash cinches that. We are creating a pipeline of prospective acquisitions in self-storage and in the diversified category, as I mentioned earlier, in a manner very similar to what I created at Crescent. So you will soon have the opportunity to meet David Wheeler in our next video. David has been president of the company and has been with the company for a significant period of time. As you know, David was recently named interim CEO, a decision that was made on a much-deserved vote of confidence by the executive committee. We have seen Mr. Wheeler mature greatly, and there is absolutely no doubt he is ready for this role. David's wealth of real estate experience, his immersion in the self-storage sector, uniquely positions him to drive our strategic initiatives forward. As you can see, we've gone in significant detail to present this narrative, and it now is essential for the company to forge a path forward as outlined in our separately included upcoming PowerPoint presentation. Critical to this path forward is the continued service of our board, and that means the incumbent members of the executive committee who have accomplished much. But we're not through. There is much more that remains to be accomplished, and that remains for work to be done for you by us. Our plan is to continue on our self-storage strategy, and that is what we will do. Each shareholder will be receiving proxy materials regarding the consent solicitation, as I mentioned previously. In summary, I thank each shareholder for your consideration of this opportunity and urge you again to vote for our slate of incumbent director nominees. That is Jack Tompkins, Jim Steele, and Gerald Haddock. And our next video communication will be coming soon, where Dave Wheeler will discuss in more detail our self-storage outlook. So thank you very much, and don't forget to vote your consent When? Immediately when your proxy arrives. Don't forget it.